Good morning, everyone, and welcome to the Superhost STR 2.0 webinar. Really excited for this update webinar. This is our second live webinar for 2023, and happy to be here with Sif Kafagi. Sif, good to see you here.
Yeah, you as well, Suja. Thanks for having us. And it's round two. Round two is always better than round one, right? So this will be fun.
Yeah, for sure. I mean, it's just really exciting what's been happening with the portfolio and watching this whole process unfold. You've been operating Fund One now for about a year and a half, and Fund Two is going to be, even better, really, because we're building on that experience of Fund One. So I'm Suja with Lux Capital Investment Group, and we're talking about the Superhost short-term webinar opportunity today. And we're also offering this fund in conjunction with Little Wing Investments, who Jesse is not here today, but he is here in spirit. And we are going to dive into the specifics of this offering and why feel so excited about it and feel so great about the track record that we have so far. So what's the big picture? So the big picture is that with this deal, you get all the benefits of investing in real estate, but specifically short-term rentals with zero work. So the big idea is that short-term rentals are an emerging asset class. So it's a non-consolidated industry where 90% of our competition is mom and pops. And there's only a handful of professional operators like us, which makes it very, very doable for us to outperform the competition and to have a pretty good idea of where we're going to be able to perform in terms of revenue. In fact, we've been overperforming with regards to revenue over the last couple of years. So the idea for passive investors is that you provide the capital and you rely on the expertise of the operators to do all the hard work, meaning identify the best properties to buy in the best markets, renovate the properties. We're going to talk about the niche that we're in and how we really set ourselves apart. So this isn't just like you go buy IKEA furniture and buy a property and throw it on Airbnb. We're actually completely outfitting these properties with it's going to be a whole experience. So tons of amenities in terms of, we could have golf courses, we could have pools, and there's just a whole host of ways that we can really set ourselves apart and make it an experience for families. So this is a $50,000 minimum investment, and it's only open to accredited investors. We're expecting quarterly cash flow, which should begin within the first 6 to 9 months of investing. And in addition, we've got baked in and growing appreciation because these are single family homes that we're purchasing. That's the niche that we're in. And as with other real estate syndications, it's like you own the real estate yourself. So you got 100% of the tax benefits. The benefit, though, of being in a syndication is that you have zero liability when it comes to the lending. That's one of the biggest risks with owning property is the liability that comes with owning property. You can there's a lot of things that can happen and go wrong with that. And when you're a limited partner, you don't have those liabilities. And the other great thing about this particular fund is that there's instant diversification. So not only are we in a dozen markets, but we're in 100 properties or more. And so we can really diversify our fund and make sure that we're trying to even out revenue over the year, because short-term rentals have a bit of a cyclical nature. And so if you just own one property in one market, then you're going to have revenue that spikes at one point and then goes down, and maybe is more to break even level at the low season. What we can do when we diversify is that we can even out our revenue over the year. So, and just real quick, what this should look like over the next 5 years is that we're going to be purchasing properties with the capital that we raise in 2023, and we will be renovating them and stabilizing them, and then optimizing them for sale to a institutional buyer. So because this is an emerging industry, there's going to be a growing demand. We're already seeing it. And Seif and his team are in close contact with many of these buyers. There's a growing demand for buying portfolios of short-term rentals. And so that's one of our main exit strategies, is to be able to package these amazing properties that we have in Fund 2 and Fund 1, and sell them as a portfolio to an institutional buyer who will pay a premium for buying multiple performing properties at once. Okay, now Seif, why don't you talk about the track record so far?
Yeah. So in our first fund last year, and Suja, thanks for having us and partnering with us even then. In our first fund, we did a little over 37.5 million in equity. We have in that one, I think we have about 75 doors of short-term rentals. We're driving significant revenue numbers on that one, even better than what we projected. So to kind of give everyone a little bit of the lay of the land. In short, if you're kind of back of the napkin underwriting a short-term rental in our world, what we're looking for is, can I get somewhere between a 17 to 21% price to rent ratio? And if I'm buying it for $500,000, right, 500K, can I drive $100,000 in top line revenue, right, give or take? And if so, then I'm fairly interested in the deal, pending all the other things that come with that house, right? And you start to dig in. And our software underwrites hundreds of thousands of deals a month and a quarter. So far in our completed projects that I've seen at least a year through, I mean, we're hitting about 27 to 30% price to rent ratio, which is a significant increase. Now we are seeing our OpEx, meaning what we're spending to acquire that revenue, is up a little bit, but you would expect that to drive that additional revenue, right? So we're driving about 50% more revenue, but our OpEx is not 50% higher. So that's where the outperformance is really occurring. And as Suja mentioned with track record, this is kind of what we call, or what we coin internally, as our STR ETF, right? So each row really is a property, and each column is a month. And just like with any well-diversified portfolio and with seasonality and short-term rentals, you're going to have properties that are going to be really, really strong one month, and then they're going to have a little bit, quote, weaker months in other seasons, right? Whether it's fall or summer, for example. We're in summer today, and summer is going to be significant, right, for us, both in terms of occupancy and revenue. We're in July. This is July 20th. I mean, we're already over $15,000 in revenue this month, which will be our highest grossing month of the year by far, right? Last month we were at about, I think it was like eight and change, right? So you'll see that's what the seasonality matrix kind of looks like down here.
Okay. And so,
Cool. And then
yeah, go for
okay,
it and talk about the exits.
yeah. And speaking a little bit of those exits, I think this is a really good slide to really understand who buys short-term rentals. So many of you probably are familiar with single-family rentals, is the closest comparison here. And retail investors love single-family rentals because they're easy to manage. They can kind of get into them. They like being hands-on. And we were able to exit 8 in our first fund for somewhere between a 5.5 and a 6.5 cap. And that's really, really fantastic for us because we really proved out the need and the demand. And some people have asked us, well, people were buying these at a 4% interest rate. And the short answer is no, they weren't, right? Some of these were sold at between a 6 and a 7% interest rate. We do think, obviously, like, with time and as rates come down, we'll come back to these 5 to 6% exit cap projections. But we do see that there's a little bit of softening today, which is also good on the purchasing end, right? We've also seen purchasing prices come down. So that's been an advantage. But these 8 really represent a segment of how quickly we were able to take a turnkey product and sell it on the retail market. And same thing with institutions. They want to buy this portfolio. They don't want to build it, right? So that's really the value that we're adding here as partners.
And another thing
is
I just want to step in here and say that, so one thing that I love about TechVestor is that they're just really crushing it in terms of outperforming the competition. So if you look at this data, they're outperforming the largest professional manager by 56%. So, and we're going to go into exactly how the software works, but what we're able to do is craft a strategy where we're buying the best properties in the most profitable markets and amenitizing them to the point where we know that we're going to be generating tremendous amount of revenue that is servicing unmet demand in those markets. And so if you can just look at these numbers, when you look at Vacasa is one of the very well-known short-term rental managers. And you look at their average revenue, we're significantly higher than them. And I think that's just really a testament to the team at TechFester and the operator that we're choosing to work with here. So one thing to expect for Fund 1 is we're going to look to purchase about 100 properties in a 10 plus markets. The average annual return that we're anticipating is about a 19% average annual return. Of course, it's a projection, but we're looking at that as a pretty conservative projection. And we're going to be distributing cash flow on a quarterly basis. And one thing to note is that, there has never been a capital call at TechFester. We don't anticipate needing that. We've got a 3x debt service coverage ratio in this portfolio. And that's really tremendous when you compare it to other asset classes that we at Lux usually invest in. Multifamily, we're often at 1.25 to 2. I mean, with adjustable rate mortgages, we're even under that right now, and using our reserves to continue to service debt. So the fact that we're at a 3x debt service ratio with this portfolio is really phenomenal. Okay, go ahead, Steve.
Yeah, so as Suja mentioned, I think the biggest advantage we have, and we call it the three T's internally, is our team, our technology, and our traction. So as a leader, I think the one thing that makes me proudest of what we have today is our team, right? We have the best people here from, Mick, who's led asset management at Vacasa, and portfolios, to people like Josh, who's our head of operations. He's XDR Horton, scaling single families across the country. We have key advisors from people from places like AirDNA, Scott Shapper, Jamie Lane, both sit in our advisory. We built our own technology, and we've done this. This number is even a little outdated on this slide. We're on property number 120 something, right, across our first and second fund. And so, in short, we know what to do and what not to do, right, when it comes to operating. So what we're also seeing, and this is a really great testament to just the advantages of investing in this fund, is it took us 6 months in our first fund to achieve our first $100,000 month. It took us 3 in fund 2, right? So we're pacing faster because we know what to do. We already have better infrastructure. We have internal policies and SOPs and procedures and how we launch things. We already have data in these markets, so we can hit the ground running faster, right? And all of these things are really fantastic. And these are even bigger reasons of how we got here today, right?
Okay, so just to go over the overall strategy, I mean, we're going to go over the business plan, the asset class, where short-term rentals are today. We've already talked a bit about the story of TechVestor and the track record. We'll dive into more about the team, right? Because the team is really what we're investing in when it comes to this particular investment. This is an operations-heavy business, and the team at TechVestor is really what makes this all happen. And we're going to go into the financials and as well as the downside protection, because I think a lot of times when people think about short-term rentals, it sounds a little bit nerve-wracking, right? Because it's hospitality, it's vacations, it's not the kind of normal real estate syndication that we're usually investing in. With multifamily, it's an easier story to understand when you're first getting into syndication investing. But what's actually really cool about this investment is that there's tremendous downside protection. And that's one of the things that I love about it. So we'll dive into that as well. And the data room is available on my portal, and you can peruse through it. There's a lot of great information on there, separate from what we're going to be sharing today. So again, this is about you're going to get all the benefits of actually owning a short-term rental. So if you are someone who's like, maybe I should invest in a short-term rental, have my own Airbnb, this is a way to do that without having any of the headaches of doing it. You're still going to get the appreciation of owning a single-family house in a destination market. You're going to have cash flow that comes from the properties on a quarterly basis. In real estate, one of the great things that, when you own a rental property is that your tenants are paying your mortgage, which means that your equity in that house is growing because you're paying a little bit of principal every month. You get that with this, and you get the tax benefits, right? We're going to get pretty good depreciation in year one. If you have other rental income that you want to offset or other passive income that you are able to offset with that. So that's why we love investing in syndications. Another thing about short-term rentals is that it's a growing asset class. So the trend is that people are using short-term rentals more and more. Of course, there's going to be a few exceptions to that. Sometimes I have someone say to me, well, I hear that hotels are priced less than some Airbnbs. And there's so many things to look at, right? But the overall trend is that our society is moving more towards wanting to stay in places where families can experience being in a vacation spot together, not having to stay in separate hotel rooms, and not necessarily having to leave their short-term rental to go and enjoy themselves. So they can have amenities like games we've got the golf courses, we've got the basketball courts, we've got soccer fields. Depending on the market, we're careful to choose which amenities we add to each property, but that's the kind of experience that families are wanting, and there's a growing trend towards that. And Steve, do you want to take this slide?
Yeah, so we're seeing demand actually pace significantly for the types of things that we buy, right? And I want to be clear what's different with us and what you might be, what you might have seen in the marketplace with news around short-term rentals. Supply is growing too fast and demand is dwindling. Well, first and foremost, two things. 99% of the market is a sub-institutional operator, right? You're talking about a mom and pop who does not operate these things professionally, full time, well designed, understand pricing, right? It's like comparing a business to a side hustle in many cases, right? And it's not the same. Secondly, we know what to buy in each market. There is absolutely advantages to buying a type of product in a market and a different type of product in another, right? So for example, Scottsdale, we only buy 4 bedrooms or larger with a pool on a certain acreage of lot, and we build out certain amenities that service certain types of avatars of people, families of certain group sizes, because we know based on the data that competitive data set is one of the fastest growing of people and groups traveling to this area, what they're looking for, and they can't find it. Right. So those are for us, that's why for us, we're typically 75 to 85% occupied at a minimum on really any given month. Market average is roughly about 55. Not to mention, our homes get twice the clicks, right? They get twice the views, and we charge 25% more because we have what people want. And as Suja's pulled up here, right? Booking nights are up, demand is up. It's a $150 billion industry, half of which that is here in the US. And one real strong indicator for us is demand pacing. I think this is a strong testament to the mobility and permanent mobility we'll see in the workforce, is people are planning out their trips further in advance, which is really good for short-term rentals, because how pricing works in short-term rentals is the further out you book, the higher premium you pay to reserve that. So not only are we able to secure, essentially, we're securing higher inflated rates in the future based on human behavior. And the more and more people do this, the more and more, as they call it in the real estate industry, push rents up, right? And we can do this on a nightly basis.
So as we've spoken to already, but just to reiterate, one of the reasons why TechVestor and this particular investment is such a strong offering is because we're in an emerging asset class where 90% of the competition is mom and pops. And so when you look at some of the news articles that are coming out, well, first of all, some of the data is erroneous. And so it's just you have to be careful what you're actually reading. There's a lot of clickbait out there. But the other thing to notice is that not only is that data potentially erroneous, but at the same time, we are at the top of the market. So we're not just your average operator. So if overall demand or supply of short-term rentals is going up, we're being extremely targeted in the properties that we're purchasing. We're not just going out and saying like, oh, I want a house in, the Smoky Mountains and buying any house. As Steve spoke to, we're buying the type of house that guests want that is not currently available, or there's unmet demand for it. So I think that's just something to really keep in mind, is that we're taking a very targeted approach, and that's going to allow us to have continuous demand, the demand that Steve was talking about, where we're 75 to 85% occupied, which is, almost a third more than our competition. Another thing about TechVestor is that they are, vertically integrated. So sorry about that. Vertically integrated. So we've got acquisition, property management, revenue management, technology, finance, design, social, and operations all in one house, which really streamlines the whole outfit and makes it so that it's efficient. It's not something that you see in general. Okay, Steve, will you take this?
Yeah. So Fund One has been really fantastic in terms of performance. We have hit and exceeded our expectations on average every single month by about 22%, 25%, rather easily, right? And the main things that are happening here is because of our ability to drive additional revenue through our amenities. In Scottsdale, we have things like pickleball courts and basketball courts and really great, fantastic outdoor spaces that drive the demand and the growth in that market. In the Poconos, our team is literally there right now, going through about 32 homes that we own, right? Improving quality and continuous improvement, right? And so all of those things are, giving us the ability to drive significant performance year over year and month over month in what we've seen in delivering that great, fantastic performance. And occupancy is an interesting metric for a lot of short-term rental operators. It's often the one thing people focus on the most. It's not what we focus on the most. And I think that's a myth, right? We focus on revenue because not all bookings are equally profitable as others. If you have a one-night booking versus a 6-night booking and the same fees and the same cleaning costs and the risks of guests, each of those is treated a little bit differently. So we look at revenue, and revenue really is just ADR, what you're charging per night, times occupancy. And on average, on any one of our homes, we're driving currently, close to about a 25 to 30% price to rent ratio. And they're trending even higher in year 2 in our first fund. We're even seeing really strong track record and performance coming out in our second fund, where today we have a little bit close to about 40 properties in our second fund, which is the fund that you guys are all considering investing in here today.
Steve, can you just break down that stat you mentioned about price to rent?
Yeah. So, for us, our average purchase price, give or take, of a house is going to be roughly between $500,000 and $600,000, right? And that's on average. We have obviously things on both ends of the spectrum. So if you just take 500 grand, what we're looking for is a home that can do $100,000 on about a $500,000 purchase price. If we bump that to $1 million of a purchase price, then we need to be doing $200,000, right, in gross revenue to kind of keep those economics generally similar. Now, for us, when we're underwriting between 17 and 21% for us to buy the deal, and we're underwriting at market. But what we're performing at is much, much better than market, right? So while we underwrite at about, call it 100, that 20% price to rent ratio, we're achieving closer to 125, 135. And that's in year 1, right? What we're seeing is significant, probably right now about 9 to 15% year over year revenue growth immediately, just because of booking lead time, right? In your first year, you don't get to benefit from booking lead time. You do certainly get to do that in second year moving forward. So we're really excited about where that's headed.
And, just want to get your thoughts on any potential headwinds you see to this current trend of like overperforming the market, Steve.
Yeah, I think inherently we're going to see a lot of, attempted competition in general, right? What we're doing isn't rocket science. I want to be very clear, right? We just know what we're doing well, and inherently there might be copycats, people that try to come into the market. But what we've also seen is we have everything vertically integrated, right? So when you think about operations, and revenue management is probably one of the things that we do the best in the entire industry, and that's completely in-house, right? We're pricing on a daily basis. We have custom and proprietary tools and algorithms that allow us to predict and automate pricing in real time. While most people are using tools like Price Labs, and we use that too, we actually have a much more deeper and advanced version of those types of things on the back end that allow us to really get down to the nitty gritty. So think of it as an if this then that statement times 1,000 by market, by season, by month, right? And we can kind of predict and automate for really the outcomes we want to approve. So I do think that we're going to see increased competition in general, but I don't think that's going to actually affect the top. I think what you're going to see is the bottom 20% kind of fall out, right? People are going to have a higher expectation of the type of product that they want to go see.
So this is just a list of some of the listings that we have. You can see the entire portfolio of Fund 1, and I've also broken out Fund 2. It's available in some of the emails that I've sent out, but you can go check out the properties online and see, what it is that we're doing. Okay, so just a quick background on me. I'm Suja with Lux Capital, and I've been in commercial real estate since 2010. I used to work for institutions that purchase multifamily properties like big banks, and I was an underwriter and a financial analyst for them. And then at some point, I decided I wanted to be on my own and built my own portfolio, actually, of short-term rentals. And that's how I replaced my corporate income, was through short-term rentals, which is one of the reasons I was so excited when I met Steve and the TechBuster team, is because I've always wanted a way to help other people invest in short-term rentals. And I just really loved what they were doing so much. And I believed in the space and understood how it works. And so it just makes complete sense to me. And Steve, can you tell us about your team?
Yeah, so most of my team, and including myself, we're going to come really from two predominant backgrounds, right? And that's going to be both technology and real estate. And so myself, I spent 5 years at Facebook scaling teams and infrastructure specifically for our production engineering team. So we're the team that made sure Instagram stayed up, as an example. And when it didn't, we got yelled at for a lot of other reasons. And I led talent and recruiting and opening up offices and hiring most of our senior leadership. So Sabrina comes from Apple. She built AirPods. She also worked on Apple Vision, which was recently released. And so she's very strong operationally when it comes to putting together process, wrangling people, herding cats, those types of things. And our extended team, people like Mick and Josh, and Austin and Corbin and Sam and Taylor and John. I mean, John's our head of data. Taylor is a, ex-baseball guy who's really good at acquisitions because everything comes down to numbers and buy boxes, right? Austin's the lead on revenue. It's fantastic there. Sam is another general partner here and our head of capital markets, and it's fantastic with organizing and raising equity terms that are favorable for investors. Hence why investors here with Suja get really fantastic terms. And Nils is also our head of fund manager enablement. So between all of us, as well as the 30 plus people that support and grow everything that we do on a daily basis, we couldn't be more stoked to be here today, as well as the advisors that we have, on a day-to-day basis, Scott, Jamie, and several other people like Nico and Laszlo. These are people who come from tech and real estate backgrounds. So those are things that really, we get excited about, to pick up the phone and say, hey, we're having this problem. Can you help?
Okay. So now I want to touch on the software. We've kind of been mentioning it, but TechBuster originally started out as a software company, and they were going to sell this proprietary software to people who wanted to be operators. And what the software does is it allows them to look at all of the data that is out there in terms of what people are looking for on Airbnb and what is available for purchase in any given market. And it cross-references these data points so that an operator can go into any market and decide like, okay, this is the best property purchase in terms of a short-term rental strategy, because this is where the unmet demand is. It turned out that when Steve and his team went out to sell the software, that people said, well, this is great, but will you just do this instead? And operations really is the heart of short-term rentals. Of course, it's nice to know what to buy, which is what the software allows us to do. But operations is really hard. Having a team that's going to make sure the unit is perfectly cleaned every single time, make sure it's designed so that it's optimized for the guest experience, for the niche that you're looking for, and making sure that there's, enough towels and toilet paper and that everything is sparkling clean, and that, it's a lot. And so, that is something that TechVestor really shines in, being vertically integrated. So that's what the software does. And Steve, do you want to speak to any more about that?
Yeah, so our software and our tools in general that we're building really answer a lot of questions: what to buy, where to buy it, how to operate it, what are the problems in that unit. For example, I'll kind of give everyone a little bit of some insight. So in our first fund, we own a little over, I think a little over 2 dozen properties in Poconos, which is about 2 hours outside of New York, outside of Boston, outside of DC. Very drivable, summer, winter, beautiful, beautiful location. And we saw that our electricity cost specifically was really, really high in certain parts of the year. So we've identified that coming from baseboard heaters in some of those units, right? Most of those units, because most of those that's how those properties are built. And so what we were able to identify very quickly, because of the tooling that we put in and this technology that we've implemented into each house, is we cut those off. We put in mini splits into every single unit. We also called and pre-bought, and if anyone knew you could do this, we didn't know we could do this until we tried. We pre-bought electricity from the state and the township, because it runs on a private line, and we were able to drive our utility cost for electricity by about 35% down, right? And you're like, well, who buys electricity 2 years in advance? Well, we do, right? Because we're going to be operating it, and we need it, and we know we're going to need it, right? And for us, they're going to pick up the phone and be like, great, well, we want to retain you because we have all these doors, right? Your average owner who maybe owns one or two at most isn't necessarily going to be able to negotiate the terms that we're going to get. So that was a small win, right? In that world. For another thing, supplies, right? I don't know if anyone wants to guess, but we have about, this month in July, we'll have almost 800 turns. And I'm saying turns, and Suja knows what turns means, because she has her own Airbnbs, but things like cleans, right? So supplies and supply restocking and cleaning costs and all those things, those are things that we can actually drive down the cost with time, with economies of scale. And that's the stuff that we've done, especially as we continue to grow in our core markets that you see here on screen, which is a blend of both destination markets and metro and cities.
And can you just speak to that, see if like why you've chosen this allocation of destination versus metro?
Yeah, so the biggest thing that we want to diversify with is seasonality, right? So seasonality is going to be like when revenue comes in during the month, right? So a market like Scottsdale has very different seasonality than a market like Blue Ridge, Georgia. In fact, they're quite opposite, right? And that's why they complement each other very well. You want also asset level diversification, right? So when you buy different assets in different locations, different types of homes, you're exposing yourself to different levels and different types of risk. You also want environmental diversification, right? So you don't necessarily want to buy everything in a flood zone, as an example, right? Or everything where hurricanes are often common. So there's that. You also want revenue diversification. You want traveler diversification, right? Basically your avatar, who's visiting your properties and where, right? But all of these markets fit into our core thesis, which is drivable destinations from major metros with high demand and low supply of the product that we buy, right? So all of these markets are going to feed into that seasonality adjustment for what we do. And the 16-point strategy that you see here, it all feeds into the underwriting that we're looking at.
Okay, we've spoken about vertically integration. All right, this is one of my favorite parts of the presentation, the design, because these properties really are just super beautiful. So I know this is a great case study, Steve, about what this was doing before you bought it and what it's doing now.
Yeah, this one, I'm going to actually pull up live data here while we're on the call, just so I can be as accurate as possible. So this property we underwrote for about $140,000 in its first year, because it was doing about $140,000 for the 3 years prior, right? So we bought it really at the market for what it was buying at. In its first year, it had 84% occupancy. It had a little over $211,000 on the book, so it did over $50,000 more than what we had actually underwritten it for. And in its second year, currently, it's trending to a $233,000, right, for its second year on the books. And really all we did here was design, cohesiveness, better operations, and absolutely better revenue management. A trick for anyone, if you want to know if anyone's actually using revenue management strategies at all, go to their Airbnb calendar, type in some random date, and look at the base rate. If it says $300 a night, type in some new dates that you want to travel in the future. And if it stays $300 a night, they're not using dynamic pricing. And I cannot tell you how many people don't use dynamic pricing. In fact, I tested this with my team during Super Bowl. So during Super Bowl, another article came out. I think it was the New York Times or the Wall Street Journal off the top of my head. And it was like in Scottsdale, over 50% of Airbnbs remain unbooked and they can't even fetch like $400 or $500 a night. All of ours were booked for over $1,500 a night, right? Because of the avatar and the group sizes that we typically focus on. Not to mention, people were absolutely astronomically trying to get, they weren't using dynamic pricing. So what we did is we rented out all our homes and then we booked someone else's home that wasn't using dynamic pricing for the Super Bowl. So we could go to Scottsdale, right, and have a good time, right, and obviously check on our properties and all those types of things, right. So that's the arbitrage of the market that's happening. And by the way, dynamic pricing is a very common thing in nearly every industry. Most of you are also familiar with it in industries like travel, hotels, airlines, right? All of these things have dynamic pricing naturally built in.
And this is just another example of what you might see on the left here is if you were to look at 90% of listings in the Poconos, they're going to look something like this, a bit outdated, just something that maybe came from the 80s or 90s. And this is kind of what TechVestor team will transform it into, something that's light and bright and modern and meets the current consumer demand. And then in addition, just little things like staging the property so that it really pops for pictures. This is the Barbie house, which is in Scottsdale also, and it's an extremely successful house because it creates that experience. It sleeps 16 or more people, and it's a very cohesive experience. So there's just a tremendous demand for it. Steve, do you want to talk about the revenue on this property?
Yeah, so this is actually a really interesting property. So this one launched in August of 2022. I'm actually looking at live data here on my other screen. And it's trending right now towards about $170,000 in annual revenue. But what's really interesting about this house is it has a little bit of a lower occupancy rate than our traditional Scottsdale home because it's a little bit more themed. And that's totally normal and expected because we're getting about $1,000 a night at a home like this. Right. So this is where that myth of people just optimizing for occupancy is really true. You look at this and you're like, oh, it's probably not doing so well. But then you look at its revenue and you're like, wow, it is really doing so well. And this home for specifically is on track right now for a double-digit cash on cash in its first year. And this home has one of the highest future bookings. This one gets bookings one of the furthest in advance because, as you might imagine, groups, birthday parties, bachelorette parties, those types of celebrations are happening further in advance, and you're planning for a larger group set of people. Therefore, people need to plan accordingly and get there, right? So when they need to do that, especially for larger groups of people, and they're willing to pay the premium, so they're all together, right, in this home. So this home is absolutely crushing it, and the episode of this out on Staycation on CBS is out. I know we've been talking about that now for a little bit over 6 months now, but I think that came out just about a month ago.
Okay, just for those of us what is Staycation, Steve?
So Staycation is a TV show put on for people who are interested in vacation rentals, kind of identifying unique and cool spots around the country to kind of go travel to and go take. And we were reached out for our Barbie home, I'm sure for a variety of reasons, to put this on the show, and they walked the show, and it's a really cool segment. So I encourage everyone to kind of go watch it. And Sabrina, my partner, walks to the house, and it's a cool little entertaining segment for sure.
And when did that go live?
I think it went live in, I want to say it went live in June, but I'll have to double check. It was sometime in the last month or two.
Okay, nice. Coinciding with the release of the Barbie movie. So,
which we did not plan, by the way. That was completely luck. Yeah.
Here's just some more examples of some amazing properties, really just those enticing photos and setting, this is a stock tank pool, and making a patio area. So you can really just take a property that's a regular home and make it into an experience with the design that the TechVestor team puts together. Some more fun photos. And, to Steve's point, every market is different. So this is something that they might do in the Poconos, which is very different than what you would see in the Scottsdale market, because we're catering to what people are looking for in any given market. In the Poconos, it's more of kind of a modern mountain feel. All right, so we kind of already covered this, but minimum investment is $50,000. We're looking at about a 5-year hold that, we don't know exactly when we're going to exit, and there may be multiple exits, but looking at approximately 5 years, 100% of the tax benefits go to the investors, quarterly cash flows, diversified portfolio. The split. So for our fund, the split is an 8% preferred return to investors. And then after that, it's a 70-30 split. So 70% goes to investors and 30% goes to the general fund managers. And this is actually a really favorable split, because what you're going to get from this split is actually preferable to what you would get if you went directly to TechVestor. And that's just something that we do because it makes it easier for us to bring investors into the fold. Again, it's passive. Here's what the average annual return is expected for every year. So I think that the thing to focus on here is year one, we're looking at about a 4% as we optimize the properties, because we're buying these properties and then we're stabilizing them. So it takes a little bit of time to ramp up. We're looking at about an 8% projected cash on cash return in year 2, 10% in year 3. And that's, I think, the most important things to take away from this particular slide. So taxes, as most of you know who've been following me for a little bit, one of the main benefits, or one of the major benefits of investing in real estate, is taxes. So we're able to take advantage of bonus depreciation via cost segregation to pass on tax benefits or tax losses. You'll get a K1 and you give that to your accountant. And if you own other rental properties, obviously you have to check with your CPA to see if it applies to you, but if you own other rental properties, or if you have other passive income from other investments, then the depreciation from our STR investment will offset that income. And it also means that you're not paying income taxes on the cash flow that comes in from this investment, most likely. Owner stays. So we want you to stay in our properties like an owner. It's not going to be totally free, but it won't include Airbnb fees. And so it'll be at about a 20% discount, 10 to 20% discount, depending on the market. And so if you want to stay in one of these properties and book out a family gathering, then we want you to do that. So we have a concierge that can assist with that. And it's kind of a fun component. You can stay in any property in either Fund 1 or Fund 2 if you invest in this opportunity. Okay, downside protection. Would you like to take this slide, Steve?
Yeah, I always love talking about protecting capital. So it's our first responsibility to protect your capital. And it's the first thing that we focus on when we think about underwriting. So kind of walk you through how we do that in a multifaceted approach. When we're buying properties, we're typically putting right about 25% down, and we're forcing equity immediately. These properties look the way they do because of substantial renovations that are purpose-built for what we do: flooring, bathrooms, roofs, HVAC. So physical infrastructure, as well as both the design and aesthetic of these homes. So on a post-renovation basis, we believe we're likely going to be somewhere between a 55 and a 65 LTV, right? Loan to value, not loan to cost, right? Now, that is a belief. We don't typically do post appraisals on those types of things, but as you might imagine, if we're dropping $150,000 into a house, I would hope it's damn well worth more than what we bought it for, right? So that's kind of the idea. So in addition to that, we have seasonal and asset level diversification, as well as geographical diversification. And all of our debt is a huge one for anyone who's looking at the space right now and investing in real estate. All of our debt is fixed for a minimum of 10 years. So what this means is anytime we take out a loan on a home, which we take out the loan, not you, right? We guarantee the debt, not you. That debt cannot be called due. Nothing will change with that payment for at minimum the next 10 years. Usually it's 30. However, at a minimum 10 years. And so because that debt is fixed for a decade, You might ask yourselves, well, why, Steve? Why do we need 10 plus year debt if we're planning on holding for roughly about 5 years? And the short answer is we want the flexibility to figure out what we need to do if shit hits the fan, right? If you look at 2008, in fact, if you look at what's happening in some multifamily projects right now, they took out floating rate debt and it was great at the underwriting stage, but when rates doubled, they got screwed. They lost their shirt, or they will lose their shirt, or they'll have capital calls, right? For us, all our debt is fixed. Not a single loan is cross collateralized, meaning every property is its own loan. If we lose one property, it does not affect the rest of the portfolio, right? Which is really awesome. And in addition to all that, our DSCR, which Suja mentioned, which is really your net operating income, that's after all your expenses divided by your debt, is over 3x. Meaning, realistically speaking, our expenses can go up by 70% or our revenue can go down by 70%, and we can at least continue to make payments on debt. We don't believe that to happen, right? I also want to make a comment on capital calls because that is an interesting thing happening in the industry today. We have never done a capital call. In fact, we do not have the right to do a capital call per the sets of our docs, right? So you will never get an email from us that says, we require you to put in more money, right, in order for you to maintain your position. That is not something we've done. That is not something we plan on doing. We feel very confident with where we're at today. We hold another 5% of invested equity, roughly give or take, in reserves and cash, right? So we're fairly well capitalized to do what we need to do.
So another thing to point out is that, a lot of people think about investing in real estate and think like, well, we don't want to invest at a bad time, right? So this is not 2008. This is a time when we want to be investing because we've got a lot of tailwinds. We've got a shortage of, well, first of all, everything that is happening in the short-term rental industry with trends. The economy is, well, we don't know exactly what's going to happen with it. With housing, we're still severely underbuilt with housing, and we don't have the lending issues that we have. So this is really a different time than 2008. And, it's important to look at those details when you're considering investments. Is there anything else you want to say on this, Sif?
I would just say that it's not 2008, but I do think now is a great time to buy. And we have one of the lowest inventories in history, if not the lowest inventory in history. And we are so far ahead of the game. Like, we're in the first inning. Like, I think a decade from now, even though we're talking about this as a 5-year investment, I think a decade from now, we'll look back and be like, wow, I really wish we would have bought. People are always bringing up, well, interest rates are really high. Well, it's not a good time to buy. Things are going to crash. We're buying at things that work today in today's world, right? So if it's an 8% interest rate and it works, I want to buy it because in 2 years I can refinance. We damn well believe rates will come down sometime in the future because if you look at any other time in history, they've always happened. So we're not buying assuming things are going to change. We're buying knowing that it works today, not depending on if anything will change, right? But we do know that the likelihood of rates coming down and those types of things happening is very high. And when they do, we'll be in a fantastic position to really, really deliver fantastic shareholder value, right? So it's to us, there is no greater time to buy than the present, and we're continuing to remain in a buying position.
All right. So again, we've spoken to this already in the presentation, but what sets us apart from the competition? We've got an operations team. We've got vertical integration across all different business lines that are required to execute this business. And we have expert operations. And we're optimizing every single day. So as Sif said, last year it took 6 months to get to their first $100,000 month. And this with Fund 2, it took 3 months. So the team is getting better and better every day. And, they're doing it at a scale that is very unparalleled in terms of the sophistication of operations and the revenue management, et cetera. So just really an expert team here. And also the underwriting is conservative. So while they were able to sell, we talked about the exits last year. So we were able to exit at around a 5 to 6 cap. but we're projecting 6 to 8 caps for exit. So, for those of you who aren't familiar with cap rate, when you think about your exit cap rate, that's one of the assumptions that can really sway the financial projections of a property or of a deal. And so we want to make sure that we're really conservative. And that's one of the things that, at Lux, we're careful about. We want to make sure that exit cap is very conservative. And while interest rates are high right now, and there might be a bit of softening with cap rates in general, we do, as Steve said, expect interest rates to ease up and start going down at some point, because that's what we've seen historically. And therefore, the 6 to 8 cap exit is conservative in the long run.
Yeah. So, Suja, if I can add just one thing there.
Yeah.
I think a common conversation I've been having with investors very recently is a lot of them are very fearful of the market today. It's not even the asset class or like travel or anything like that. They're just fearful of investing. And I totally get it. And a common question I get is, what's the worst case scenario? It's a very common question. So here's what I tell people. We have fixed rate debt for at least a decade. Okay. So as long as you believe that people will continue to move around somewhat and Airbnb will be around, and we know that fixed rate debt is there for at least 10 years, our worst case scenario, and this is what the underwriting says, is if we held for a decade, 10 years instead of 5, which I know isn't optimal, it's not the initial plan, but if that's what had to happen, right? And we operated at higher than average cash flows because we would, that's how the industry is currently operating, right? And we sold these homes back to the market, single family market, as single family rentals. Just normal homes. We're not talking based on any revenue or cap rate or anything along those lines. We would generate roughly somewhere between a 10 and a 12 IRR. I know that's not something to get up and necessarily shout through the roof, right? Of like, wow, that was incredible. And I really want to do that again. But we preserved investor capital. Everything is relative to what's going on in the world. We had higher than average passive income. This is absolutely an income play, in my opinion, compared to some other options, right? And we navigated whatever headwinds happened that we didn't predict. That's why I really am, I'm all into this investment myself, right? I'm really passionate about this, as is our team. And we really like this risk adjusted profile that we're in. So if we don't have a home run, we're still going to hit a single here. And I think it's going to be pretty good.
Awesome. Well, that pretty much wraps up our presentation. I want to now, there's been a few questions that have come in and I'd love to run through them, but just before we do that, the deal is all set up on the portal. So if you are interested, you can, and you want to invest, you can go ahead and place your soft commitment. We have a funding deadline of August 15th. That's the next funding deadline to get into this particular fund. And if you have any questions, make sure you can reach out to me, Suja. I know all of you. We'll make sure that this information is available. And okay, so let's go to Q&A. Someone says, I belong to a company that owns many tax liens. This company has taken possession of many of these properties and now has them for sale. Do you purchase these types of properties?
Happily, if it's our buy box, right? We've actually explored this quite a bit. And this is not the first time we've seen this, where someone will come to us and say, hey, we have 3,000 doors that are likely to be foreclosed on or something, right? The issue is we're not a bulk buyer, right? For us, we buy a very specific type of home in a very specific type of buy box in a very specific area. So it's not like we just want to buy a bunch of single families, right? It's like a Blackstone thing. For me, it's like, does it meet all of these requirements? Because it's part business and part real estate and part hospitality. So, there are streets I want to own. So if they have, if they own the street, I want to own the street, right? But I don't necessarily want to own 3,000 random properties in Scottsdale, but there are streets in Scottsdale I want to own, certainly.
Awesome. Next question is, there was an article recently that said that Airbnb bookings are down 40 to 50%. What do you make of this?
Yeah, so that was put out by a YouTube content creator who is a doomsday content creator for clicks. His name is Nick, fantastic fellow he is. Um, but he was looking at data in what's called revenue per available listing. And meaning he was looking at, and everyone here knows you can manipulate data however you want to, right? And like that's kind of the problem. And so he looked at basically total revenue divided just total number of units, including things that were like available for one night a year, which is just not even realistic to compare as a normal Airbnb. And so actually our advisor and the chief economist at AirDNA, Jamie Lane, actually responded within about 48 hours and debunked the whole thing using actual data, right, that AirDNA has. So that is absolutely clickbait, just to keep that in mind. And for us specifically, we're seeing things pace even better and faster than ever before. Again, I don't think we are mass market data, right? So we even look at mass market data just very sparingly. We are firsthand, we use our own data, right? Because we see what we're doing in these markets and what we can continue to do because there's not really a competitive data set to us.
Okay, awesome. Next question is, what do you think about what's going to happen to travel demand when and if a recession comes?
I mean, I don't think a recession is coming. That's my personal opinion. I don't think the data would suggest that a true recession is happening. I do think that if anyone actually saw July 4th, that it was the most traveled TSA screened thing almost in a very long time, right? For lack of a better word. If a recession was to happen, here's something I want people to remember. We don't buy luxury properties, even though we charge like luxury ones. We buy middle of the road properties and drive the most value out of them. We are your typical class B value add type multifamily deal in the short-term rental space. We're not buying $1 million plus homes where people can't afford us. We're still more economical than going to a hotel for the group sizes we accommodate. We have better amenities, we have better hospitality. All of those things are going to continue to drive demand for the type of product we buy. And even if there isn't a recession, mobility is permanent. I don't think that's going anywhere. Like, I mean, however many people are on this call and who are going to watch this video, how many times do you go into the office? Is going to the office more hybrid now than it was before? Is it likely to go back? It's very difficult to change permanent human behavior when people are accustomed to it. And that's going on for hundreds and hundreds of years.
Okay, next question is, how did you decide to focus on this niche of like bigger families and bigger gatherings?
Yeah, data, to be quite honest with you, right? So I'll give you an example, right? When we look at Scottsdale, there's over 30, I think last I checked was about 31,000, 32,000 listings in Scottsdale. And when you look at the homes that are available to parties of usually 10 or 12 or larger with a pool, with enough acreage and amenities, that the type of avatar that's going there, which is usually larger groups, they can't find enough product to stay at, like the ones we're building and amenitizing, because that product makes less than 10% of that market. Right. So one of the fastest growing, highest growing segments of travelers to Scottsdale is going to a market where 90% of the supply doesn't meet their needs. Right. Mm-hmm. And so for us, it was just a supply demand imbalance and we're filling it. Again, it's not rocket science, but we're just looking at the data. And of course, I think we have a different mindset. I think a lot of retail investors are terrified to spend money. We spend money, right, to amenitize these homes and run them as very profitable businesses, right, as well.
And the next question is, how do you decide if a market is going to be like to go into a market and that it's going to be profitable?
Yeah, so we do what we call market mapping for months, if not years, sometimes in advance, right? We're looking at physical real estate supply. Can we get enough density in this market? And density to us is both by unit count and by revenue. We also look at like who's the competition. That's both quantitative, meaning how many listings, what their revenue is, and also what they look like and what their operations look like, right? Because you can start to win and arbitrage on significant fronts. And we track a lot of those insights. We stay at those homes, we walk those streets, and we get a lot of general data just by doing that, right? But we also learn from one market and what we can bring to another. And a great example of this is we took what we did in Scottsdale, like these fairly well amenitized homes, these beautiful pops of color, and brought it to like our Tampa Clearwater market because that didn't exist there. And it's worked out really, really, really well right? So we're being able to now cross because what we've realized is the type of avatar that goes to both is similar yet different. They're both large groups, but Clearwater is way more family oriented compared to, say, Scottsdale, which is typically more like adults that are typically traveling there collectively, but they both actually want the same thing, right? And when we read the reviews, it's similar. I didn't want to leave. All the amenities were here. This is fantastic, great location, super easy check-in, all of these things that your average people aren't doing.
Okay, awesome. And what would you do if a market became saturated with the types of properties that you offer?
So that wouldn't be for a very long time, talking like thousands and thousands of doors of properties like ours. And I think half the battle is finding the right property, setting it up. Half the battle is running it, right? So unless they have our vertically integrated staff, our software, our data sets, our people, our talent, that's going to be a really, really difficult one to accustom to. In fact, one thing that we say internally is, the longer we keep doing this, let's say we're 5 years in, we will always be 5 years ahead. You don't, you in this industry, you have to go through what we've gone through, made the mistakes that we've made, learn the things that we've learned. There is no cutting corners, right? So the track record here and the vertical integration that we have is just not something that's easily replicatable.
Okay, awesome. And Jen, see, just as a follow-up to that, could you speak to like just some of the lessons learned as an example?
Yeah. Out of our first fund, 78 doors or so, I would say 75 of them were good buys so far, right? And we had three that I would question. And when I say question, I'm talking about like they hit like a 6.5 cash on cash. Like I'm not saying they were complete losses, but we could have done better. And we didn't buy the right product in that market. Maybe we bought a 2-bedroom home instead of a 5, right? Because we didn't really take the time to better understand the diligence of what we were buying in those places. We could have better amenitized them. We went through in our first fund and probably did about $400,000 in continuous improvements across our portfolio, because we picked up on things halfway through that were like, we should have done that, right? And the good news is these are all like, driving additional revenue. So they were good decisions. We should have done them earlier, but we caught them, right? So it's like we should have added a mini put, we should have added a hot tub, we should have done this, and we go back and we do that. So we look at the data every single day and we're like, how can we make this better? Right. And those are things that we continuously think about.
Okay. And then one question came in. So would you sell a property if it ever did get to a point where there was enough competition in a given market?
I think every property in our portfolio is always for sale at the right price. And I think that's a responsibility that we have in a fiduciary duty to shareholders is, if someone offered us a certain price point for the portfolio today and it made sense, I think that's something we should consider, right? Whether it's based on competition or not, but I firmly believe in our ability to operate. So I don't think a reason for us to exit a market is likely going to be competition. It's likely going to be because the offer is good.
Awesome. All right. Well, that was our last question. So thank you everyone so much for coming to the webinar and for viewing this. It's been awesome to have Sif on here. And for those of you who are interested in investing, make sure to reach out to me. The deal is available on the portal. It's all set up. You can just definitely go through the investment portal, fill out your paperwork, and be ready to go. If you have more questions, feel free to reach out to me. I'm definitely available for chatting about this, and we'll be happy to answer any questions that come along. All right. Thank you, everyone. Goodbye.
Thanks, Suja. Bye, everybody.